Hey Facebook, YouTube, internet, this is going to be a non-visual video. It's simply just me and my ugly, weirdy, beardy face just talking. So hopefully you can listen to this on a dog walk or a bike ride or whatever. But basically I'm seeing a lot of idiots or naive people in the UK property space that are saying that this is the bottom for UK property and that there's no more stock market crashing and that you need to buy. And yeah, I just think this is utter poppycock. So before we get into the content of all this, I just want you to know that I have no agenda or conflict of interest here, as it really doesn't affect me whether you buy or don't buy a house, or agree or disagree with this video. But if my experience or knowledge has any weight in your mind, then I simply urge you not to buy any residential property if you're doing it for investment purposes. Same for stocks. It really doesn't affect me whether stocks go up or down, or if you buy equities or funds or you don't. This is a no agenda stance here for me. I just want to be your dose of realism in this hypey-emotionally charged topic, as UK citizens tend to be born with the idea that property always goes up. But it doesn't, not in real terms at least. So yeah, and also the other caveat is that if you want to buy a house just to live in because you want to house your family or upgrade where you're living for your family, and you're not fussed about the price and you don't care about going into negative equity, then yeah, sure, crack on. So I think a lot of these buy educators or people are suffering from a few things. One, conflicting interests. Their living may be from property training, or they may be a mortgage advisor or an estate agent, etc. So they stand to lose income if people don't buy houses. They're also probably suffering from Dunning-Kruger effect, the Dunning-Kruger effect, where they may have little knowledge of the markets but high confidence in thinking that they do. Perhaps because they've done well over the last 10 years in property, but they're unaware of larger macroeconomic cycles and trends. So yeah, and I think it's just they just don't have a clue what's happening behind the scenes right now. So in other videos and posts I've talked about why it's highly probable, really probable, that we're going to see way more falling in the markets in general across the globe, not just the UK. But this video is why I think UK property prices, residential, has much more falling to come. So a bit of background, the predominant reason why we've had a booming housing market since 2009 is mainly due to ridiculous currency supply expansion, as central banks tried to print their way out of oblivion during the subprime mortgage collapse. That credit then flowed into the money markets, banking and property markets, etc. And it created an artificial stock market rallying, which made people feel happy. Construction firms got lots of credit, it started lots of building, and it also converged with demographics. So the millennials entered the period of their demographic spending wave where they were buying their first homes. And also starter family homes, so to speak. So there was actually an increase in demand over the last 6 years or so. And combined with the glut of cheap credit in the banking sector and big builders simply exacerbating this demand, they were offering lots of fancy mortgages, and developers had the time of their lives. So it's fundamentally pivotal that you understand what makes UK house prices go up and down, and it's not by the conventional thought of demand versus supply. There have been numerous times in history throughout the world where there's been a massive lack of supply, yet house prices still crash. And in the UK right now, there's actually a lack of supply. There are some reports that say that we need another 3 to 5 million houses need building. So, sorry, someone just pinged me there. So people may have read headlines like this and then quickly developed an uninformed opinion that property can only go up because we're short of houses. Wrong. The single main reason why house prices go up, and here and in the US, is due to mortgage issuance. Okay, please remember that, it's mortgage issuance. So people get approved for mortgages, and so they go out and buy a house. Quick side note, I always cringe when people say that they've bought a house, or they're standing in front of their house with the keys. They haven't. It's the lender's house, and it isn't theirs until they're mortgage free, which rarely ever happens. You're just a debt slave until you pay it off. And when you look at the equity repayment curve, like, you're not really paying much of the equity out off until after sort of year 9, year 10, because statistics show that people get a new mortgage every 8 years roughly. So like, you are literally a debt slave unless you pay off a mortgage. And when you start to remortgage, the banks are like, yes, thank you. Because if you were to buy a 200 grand house or 200 grand mortgage, etc., the banks make roughly the same amount in bank interest over a 25-30 year period. So yeah, that's why banks love giving out mortgages. Yeah, here, have a 200 grand mortgage, because they're going to make 200 grand in 30 years. Or forever, or more. So yeah, little side note there. So basically, the more people that are issued a mortgage that then go out and buy a house, and then this buying cadence. So if this buying cadence maintains or increases, then house prices go up, and over 73% of house purchases are done via mortgage, not cash. So it's like a self-licking lolly, because the more mortgages issued equals rising house prices equals the more equity a bank has, so they can lend more, and then also more developers can get access to more funding, and then they can build more houses, etc. So it's like this ongoing merry-go-round. But then finally, macroeconomics or cycles catch up, and eventually you get into the situation where lenders struggle to find suitable borrowers. They then may soften criteria and even give 100% mortgages, etc. But eventually, mortgage issuance decreases, and therefore house purchases decrease, and so house prices slide. Or you get into the situation where something happens in the credit markets, so lenders abruptly stop lending, or you get into the situation where finances of the masses get clobbered, and so people just stop buying or up-leveling their homes and just hunker down. So what's happening right now is all of those situations. And what we've seen so far is simply an hors d'oeuvre of what's to come. So if I've confused you so far, all you need to remember is that if the amount of mortgages issued decrease, then house prices also start to decrease, albeit with a bit of a lag. And it's that lag of naivety that catches out a lot of property investors. Just like during the roaring 2000s, and everyone was a property investor. And then the bend at the end came in 2007 and 2008, and it ruined a lot of people. Well, now we've had the roaring 2010s, and it's the beginning of the bend at the end. Remember, the trend is your friend until the bend at the end. So we're now in a situation where quality borrowers have dried up, or they've already got a mortgage, and the banks have so much toxic debt on their balance sheet that they don't want to lend to people. The government wants the party to continue, and so it tries to entice banks to loosen mortgage eligibility criteria. I can never say that. And so I won't be surprised to see proper 100% mortgages or 110% mortgages like in 2008. But everyone's finances have been hit hard, and so the whole market is now frozen. No more buying, no more selling. And this freeze of the property market is going to catch a lot of people out. They think, once the freeze stops, and the clogs start moving again, property prices are going up. But remember, less mortgage issuance equals prices dropping. This is so clear when you can see what's going on. And right now there's the biggest economic storm ever upon us, and it won't be long before a major bank goes bust or needs bailing out. So keep your eyes on a major property builder or lender or insurer going bust, or Deutsche Bank. And this will be the final blow to mortgage issuance, and property prices will then plummet in general, more so with the higher end houses. Also, don't forget that in market crashes, it's the middle class that get wiped out, not the lower class. The lower class typically have no market exposure, so they're not losing out on stocks, etc. And they aren't the ones going out getting 150 grand mortgages or more. And typically it's the lower class that end up getting bailed out with social programs when shit really hits the fan. So it's the middle class that absolutely gets obliterated during crashes, and it's that demographic that does the bulk of property buying. And remember, everyone's had a massive reality slap around the face right now, and they've suddenly realised that they need 3 to 6 months of rainy day fund due to income insecurity right now. So what we will see is that people who were saving up a deposit will now be reluctant to blow 10 or 50 grand on a house deposit, and instead be more frugal and think twice about buying another house or another car or whatever. It's affecting everyone, literally everyone. Also, mortgage delinquencies are exploding in the Western world right now due to this economic pandemic nonsense or debacle. So we're now entering an eerily similar situation to what happened in 2006, 7 and 8, where people started forsaking their mortgages en masse. Evictions and the house going back to the lender take some time to play out, which then creates another lag, which screws a lot of people over. And yeah, this is why, like in 2008, you saw delinquencies go through the roof, but the stock market carried on going up. So there's that lag of, when evictions and all the the legal beagle stuff plays out. So when the house goes back to the lender, i.e. the bank, they don't do anything fancy. They don't go and try and rent out the house to people. They don't put it on Rightmove. Typically, they simply offload the properties as fast as they can, because it's a big old negative weight on their books. So they simply package up hundreds or thousands of foreclosed properties into a security, and they then flog or try to flog that security on the markets, hoping that other banks or big investors will fancy buying a small town. But these are essentially junk bonds or junk assets, so no one buys them. Or if they do get bought, they're bought for pennies on the pound. And so this massive discount immediately drops overall house prices across the country or in that localized area. So long story short, I am massively bearish on UK, US and Canadian property prices. I'm personally going to wait until the equity markets capitulate. They haven't capitulated yet. So really I'm looking for something like a 70 to a 90% equity crash from top of drop to bottom of drop, and then we'll see the metaphorical blood in the streets as the media will no doubt propagate the scale of the crash. So what happens with delinquencies is basically debt destruction, because and debt destruction is basically a contraction of the currency supply, and so there'll be scary signs of monetary deflation, and so the government will literally shit themselves and do even more ridiculous stimulus to bat away deflation, which is actually what kills governments. And the insidious thing that happens here is that when deflation kicks in, or it's then when deflation kicks in, because governments or countries start defaulting on their obligations. So they go into stimulus overdrive. Then big inflationary effects eventually kick in and accelerate out of control. And combined with countries falling into junk ratings and defaulting on obligations, interest rates then zoom up. This is the final nail in the coffin for a nation. Now, a lot of people think, the Bank of England will never let rates go up because it will cripple the country. Well, yeah, rising rates will cripple the country, but the Bank of England can only control interest rates within a small localized range. It's the global bond market that actually dictates bigger interest rates. So yeah, regardless of interest rate mitigation, interest rate increase mitigation measures, which is why you see Greece, they went from 4% to 23% in a year in terms of rates. So yeah, it's when interest rates rise, that's the big property price killer, because it simply exacerbates the downward cycle of people forsaking their mortgages. And so, for example, the real scare or the issue with rising rates is that, let's say you have a 200 grand mortgage and it's an SVR, so standard variable rate mortgage. For every 1% that UK base rates go up, the homeowner will have to fork out an extra £120 a month, roughly, depending on what rates they've got. So if rates then go up slightly to even 3%, the homeowner will then have to fork out an extra £360 per month. And most people can't afford an extra 60 quid a month, let alone an extra £360 per month. So yeah, it is all rather scary. Anywho, during this crazy stimulus, I'll personally, my game plan is I'm personally going to try and borrow as much cheap or free credit as possible, and then immediately plonk it into non-inflationary assets like land, some property, but outright, no mortgages, Bitcoin, bullion, and de-levered cash flowing businesses. So businesses that are still cash flowing in this crazy period with no debt. So when the big inflationary effects kick in and trickle down into the economy, they're simply going to inflate the prices of these non-inflationary assets. I mean, put it this way, if you've only got a set amount of gold or Bitcoin in the world and the currency supply goes up, well guess what? Prices also go up, and your purchasing power also decreases. So that's my plan, at least. Remember, history doesn't always repeat itself, but it really does rhyme really freaking well, but normally with a sinister tune, because human nature never changes and government actions never change, mainly because politicians have no idea about economics. So for the love of Elon, please just don't go out and buy a house or rent a house out, buy to lets like every man and his dog is doing right now. You're gonna get roasted and stuck in negative equity. I still have people that are stuck in negative equity back from 2008. It's yeah. So this may piss people off, but I'm not here to make any friends. I just want you all. Well, what do I want? I want a hug. No, I just feel that the people need to hear this information or side of the coin, because this side of the coin people don't really hear about. And I don't want to get drawn into any lengthy debates, but I'm the world's most open-minded investor or person, so I'm fully aware that you don't know what you don't know. So if there are any factors or data which I'm missing, please do let me know in a non-dick way, because I'm the first person to pivot a stance or opinion or belief when new data arises or valid contradictory evidence appears. So yeah, that's that. And yeah, I just basically feel like I'm a meteorologist right now, and I'm out there trying to warn farmers not to plant seeds or buy more tractors. And they're like, oh, you know nothing, Siam. I've been a farmer. I'm a 5th generation farmer. I've been farming all my life. And I know more about farming than you. Meanwhile, oblivious to the farmer, the biggest hurricane in history is inbound just beyond the horizon. So it's time to hunker down, folks, and wait for the dust to settle before wasting a wadload of capital on a deposit. Remember, it's always better to be prepared and nothing to happen than, thumb in bum, mind in neutral, and then something happens and you're screwed. Yeah, so yeah, I really hope this helps. So if this video saves one person from financial catastrophe, then my mission is complete. Toodles, bye bye.